Yes, there are still costs. There are never loans that get done without costs, regardless of what the internet and advertising tells you. There are title fees, credit reporting fees, possibly appraisal fees, recording charges, et cetera, et cetera. And if you think that a lender is going to do a free refinance for you because you're just such a great guy or gal, then I've got some oceanfront property in Arizona that I'd like to show you. So there's always costs. It's just a matter of who is paying the cost, you or the lender on your behalf. Hello to all you internet explorers out there. You have stumbled upon the Texas Real Estate and Finance Podcast Real Estate Market Update for the week of January the 16th. And guess what, everyone? We very well might be starting to see a light at the end of this declining market tunnel. We have rising inventory, which is good for buyers, declining interest rates, also good for buyers, a weakening economy, believe it or not, good for buyers, and a Fed looking to possibly start cutting rates very, very soon. So if you've survived as a realtor, title rep, or lender through all this recent turmoil, then you might be perfectly positioned to start the next chapter of success in your real estate career. And I am here today to help. My name is Mike Mills. I'm not only your balding host and companion through this exciting industry that we all know and love, but I'm also a local North Texas mortgage banker with Geneva Financial. And when I'm not dumping word salad into this microphone each week, I'm helping your clients get into the home of their dreams. With rising home prices, outrageous insurance costs, and high but slowly declining interest rates, navigating the home buying process can be intimidating and overwhelming for anyone. But my team and I are experts at breaking down this complicated process into easy, understandable steps to put your buyers at ease and let them focus on the most important part, looking for and finding that perfect home for their family. And the best part is, when we all reach the finish line of the transaction, my team's going to make sure that this experience will get you 8 more referrals from that client. My job is to make your job easier so you can help more people live the American dream of homeownership. So if you're looking for a partner to build for the future, give me a call and let me show you how we can help. All right, enough about me. How are we going to help you expand your ever-growing real estate brain today? Well, per the usual, we are starting with mortgage rates. We had a big week in the bond market last week, and we finally found our way back to the 6% neighborhood. Now, this isn't necessarily great news for the economy as a whole, but it is for those of us trying to make our way through real estate. And I'm going to tell you how we got here. Housing inventory is starting on its annual decline down. However, rates are also starting to decline, along with home prices as well. All this spells great news for buyers. But 2 states are leading the charge in inventory gains and not looking to slow down anytime soon. And you guessed it, Texas is one of those states. I'll tell you what all that means for your business. Now, I'm sure that almost everyone is aware of the significant and historic news that happened this weekend. U.S. bankruptcies hit their highest level in 14 years. What does that mean for your business? I'm joking about that being the biggest news story, obviously, because the fact that single women who have lower household incomes in an increasingly unaffordable housing market and yet still hold a significantly larger share of home ownership than single men should be celebrated and evaluated to help you focus your marketing. I'm going to break it down for you. Okay, enough with the jokes. Former President Donald Trump had his life threatened in an assassination attempt this weekend. I'm going to briefly share my thoughts on this. It's not real estate related, but it is on everyone's mind. So we do have to touch on it just a bit. And finally, for my main topic today, with rates starting to fall and expected to continue into the fall, you're going to have clients that have bought from you in the last couple of years reaching out and asking when they should look at refinancing. Well, today I'm going to break it all down for you so you can be the expert in all things real estate for everyone who calls your number. So tune into the end and learn when refinancing makes sense. Now, before we start, if you find today's episode helpful in any way at all, please do this Texas native a solid and share it with your network. The growth that we are experiencing is amazing. We got some big time guests on the horizon, and we are building our listener base each and every week. And you guys are the reason why. So keep up the great work. Like, comment, and share this post with anyone that you think it might benefit. As a matter of fact, I just found out recently that Spotify launched the ability to comment directly on their app if you like what you hear. So to all my Spotify listeners out there, drop us a hello. Where are you listening from? I would love to hear from everyone. So drop us a note. Greatly appreciate it. Okay, first up, say it with me. Hey, Mike, what are the rates? Well, according to Mortgage News Daily, as of July 15th, 2024, the average 30-year fixed conventional mortgage rate on the market is 6.81%. The average 30-year FHA rate is 6.26%. The average 30-year VA rate is 6.29%. The average 15-year conventional rate is 6.30%. And the average jumbo rate is 6.62%. Mortgage bonds benefited greatly last week after headline inflation declined by 0.1% to 3.0%. That's the lowest level that we've seen in over 3 years. Core CPI, which strips out food and energy costs, actually increased 0.1% month over month and a 3.3% increase from a year ago. But this increase was the smallest that we've seen since April of 2021. So this just all means that the rate of inflation is slowing. And with higher unemployment and declining inflation, the market is looking to and expecting a possible rate cut at the Fed's September meeting. We still have a few months of data coming our way between now and then. But if things continue along this path, we might start to see a light at the end of this high rate tunnel. But only time will tell. Now, the reason for this drop in headline inflation was due to a decline mostly in gas prices. They fell by 3.8% in June, which helped offset the 0.2% increase in both food and shelter costs. Housing-related costs have been one of the most stubborn components of inflation and makes up about a third of the overall CPI calculation. So a significant slowdown in growth of this number not only helped for June's reading, but is also expected to start driving down future inflation data because of the lag effect, which I've explained in previous episodes before. Now, another big impact on lower inflation numbers came from auto prices. Used vehicle prices decreased 1.5% on the month and were down 10% from a year ago. And this particular item was one of the main drivers of the initial surge of inflation back in 2021. So if you're in the market for a new or used vehicle, they are getting cheaper and cheaper every single day. And with the end of the year right around the corner, December of 2024 might be a great time to buy that car that you've been looking at. Now, with all of this and with the employment data really starting to show some weakness, although we've known it's been weak for quite a long time. By the way, shout out to Danielle DiMartino Booth for staying on top of all those labor numbers and really showing us the BS in the BLS numbers. But again, with all of that as a backdrop to a weakening economy, the likelihood of a rate cut in the September Fed meeting now stands at almost 100%, according to the CME Fed Watch tool. Now, does that guarantee a rate cut in September? No, but it does indicate the overall market sentiment is that we're about to get that long-awaited Fed pivot. But be aware, 0.25% change in the Fed funds rate is not going to turn around the market in an instant. In fact, historically, when the Fed does begin to pivot and cut rates, that typically signals things starting to get worse for the overall economy. So although a rate cut is a welcome change, historically speaking at least, it might be the start of a significant economic downturn. Time will tell, but we're all excited about rates and costs coming down. So stay tuned for future updates. Okay, since rates are starting to head in the right direction, what does that mean for the housing market as a whole? Well, according to Mike Simonson of Altos Research, nationally, inventory dipped last week. It was a week that did include the long 4th of July holiday weekend, but home prices dipped as well, along with new listings. Now, by the way, this isn't unusual when it comes to the 4th of July weekend. But in 2022, inventory rose by 3% during this same week. And that was really the start of the market turning down on all of us. Good times there for sure. I still got a little PTSD from all that. So right now, there are about 651,000 single-family unsold homes on the market around the country. That's just slightly below where we were last week, but 38.5% higher than this time last year. We still do have 32% fewer homes on the market at this time than we did in 2019 all across the country. Now, the market did add 57,000 new unsold listings last week, with another 11,000 that went immediately under contract. Now, Simonson points out in this Housing Wire article that he likes immediate sales numbers as a gauge of organic levels of market demand. So Mike says, the more people waiting to buy the right place, the more who jump on a deal when they see it. Only 16% of the listings were immediate sales this week, and that's super low and has been declining since May. And the 68,000 total new listings is actually 6% fewer sellers than last year. And right now there's about 382,000 total single family homes under contract. And that's relatively unchanged from last week and just 1% more than a year ago. Sales are slow and not growing, but lower rates might help that. Right now, the median price of all listings is about $450,000, and that's down just about 1% from last week and unchanged from last year. Mike also notes in the article that some 38.3% of the nation's listings have taken a price cut from their original list price. And that's more price cuts than any recent July that we've seen. Now, he points to this number as one of the reasons that he continues to expect home price appreciation to decelerate. In his mind, it's a leading indicator of where the market is headed. Now, those are national numbers, but what about right here in the good old Lone Star State? Well, around here, we're seeing a little bit of a different story. And depending on your point of view, it could be a good thing or a bad thing. So according to Redfin, there are currently 162,714 active homes for sale in Texas right now. And this is the highest inventory level that we've seen in almost 10 years, which is very good for affordability. The median list price is about $389,000 across the state, also slightly higher. But again, This is median, which is a mix of sales and not necessarily the average value of homes. The average price per square foot right now is about $182 a foot. But Texas and Florida are experiencing inventory growth like we have not seen in some time. And this is a good thing. Now, it would be better if sales growth came along with this, but higher inventory will eventually mean lower prices, and therefore more buyers being able to afford more homes. So ultimately, this is good for the long-term health of our market, just maybe not so good for any sellers that have homes sitting on the market right now that aren't being sold. Now, hopefully lower rates will spur along more transactions, but we may have to wait until we roll around to spring next year, because this fall and winter, although do we even really have falls in Texas? Anyway, the next few months will most likely be slower than we've seen in some time, at least as it pertains to sales volume. But all of that is shaping up to give us a big time bump when buying season rolls around again next spring. So inventory is climbing, but this is great news for affordability. All right, let's move on to a couple stories that could impact how you manage your business this year. So first up, U.S. bankruptcies just hit their highest level in over 14 years. 346 companies have declared bankruptcy through June of 2024. This is the most since 2010. A year after the great financial crisis. U.S. bankruptcies have also recorded their largest monthly increase in the last 4.5 years, with 75 new bankruptcies in June of 2024. Even during the 2020 pandemic, the highest number of filings in any given month was 74. And the highest share of bankruptcies have been in consumer discretionary companies, with a total of 55. These are the type of businesses that you don't necessarily have to or need to purchase the stuff that they sell, but you want to. Discretionary income. Now, all of this is just further evidence of weakening consumer spending. And this is another contributing factor as to why we have seen such a slowdown in home sales volume. Companies are struggling right along with the consumer. And that means big purchases like a home might be put on hold for the foreseeable future. And remember, the decline in rates is directly tied to the decline in our economy. And this is just one more red flag that indicates that we might be in for some rough waters ahead. Now, this next story isn't breaking news or anything, but like me, I don't think many of you out there realize the impact of this. But when you think about it, it makes absolute total sense. So in 1981, the National Association of Realtors first started the profile of home buyers and sellers, and a stunning finding was made. Single women outpaced single men in the housing market. In fact, single women were second only to married couples when it comes to home ownership. In 1981, 73% of home buyers were married couples, 11% were single women, and 10% were single men. And today, those shares stand at 59% of married couples, 19% of single women, and 10% of single men. So even with lower household incomes and an ever-increasing unaffordable housing market, women are kicking our butts today when it comes to building wealth through home ownership. And what's really crazy about this stat is that it wasn't until 1974 that women were legally protected to obtain a mortgage without a cosigner. You see, before the passage of the Fair Housing Act, which prohibits against sex discrimination in housing-related transactions, and the protection of the Equal Credit Opportunity Act, it was very commonplace for a widow to need a male relative as a cosigner if she wanted to purchase a house. Because under federal law, women had no legal recourse for this or any other lending discrimination. And then again, the numbers obviously bear it out because immediately it showed that they're being more responsible, having better credit, paying their bills on time, and doing much smarter things with their money. Shocking, I know. Now, knowing all this now should shape how you conduct your marketing activities for now going forward. Who's your ideal client? Where are they buying? These are all questions that you need to know the answers to. And apparently Beyonce was right again. Howdy, single ladies. Howdy, single ladies. For housing, that is. Not for me. I found one of those single ladies a long time ago. And that was terrible singing, by the way. But, got to make it fun. Okay, and one last thing here before we get to our main topic, and this is just because I need to do this. As I'm sure all of you know, former President Donald Trump had an assassination attempt against his life this past weekend. Now, whether you like the guy or not, I think everyone can agree that this is not the road that we want to see our country headed. The internet right now is ablaze with conspiracy theories on how and why this happened, but the reality is that no one knows yet. And honestly, most of us probably never really know how this person was able to get into a position to potentially do irreparable harm to our political discourse. But luckily, Trump made it out relatively unscathed and had some epic images that will live on the internet forever to show for it. And he most likely sealed his victory as the next president of the United States if he hadn't already. Now look, I am not a huge fan of President Trump, but I don't really have any love for the Biden administration either. I just don't want a repeat of all the political chaos that plagued us in the 60s when we lost some of our greatest leaders of all time in a very short span of a couple of years. And while it is incredibly tragic that a firefighter did lose his life in this assassination attempt, I'm honestly just glad that this poor misguided kid missed. Otherwise, it might have triggered things and events that none of us want to live through or experience. So please, just let us try to get to November and let the people make their choice. It's an illusion of a choice that we all have between these two guys, but I digress. I just hope we can make it to November with everybody healthy and safe, because the alternative to this could have been much, much worse. All right. Now, with mortgage rates starting to fall and a possible Fed rate cut on the horizon, many homeowners are going to begin asking when they should look at refinancing their mortgage. Should you do it as soon as rates fall below where you are, or should you wait to see if they fall even more? Well, good news. I am here to answer all of those questions and more. Now, if you own a home, then this is going to be something that's going to be of interest to you. But most of you guys out there listening are realtors, and I'm sure most of you do own your homes. But if you don't, this is still important for you as well. Look, I do this each and every week so you guys can better help your clients with all of their real estate needs and be their go-to source for all things homeownership. And interest rates and refinancing is just one more piece to this real estate puzzle. So the more you know about how it works, the better you position yourself as an expert in your field. All right, first off, what kind of refinances are there? Well, there's rate and term refinances, cash out refinances, streamlined refinances, and home equity lines of credit, or second liens. Today, we're mostly going to focus on rate and term refinances. I've talked about all the others in past episodes, and I'll dive more into this topic in the coming weeks. But a rate and term refinance is just what it says. You're refinancing your loan to get a different interest rate or a different term, like going from a 30-year term to a 15-year term. Now, if you have a VA or FHA loan, you have the option to do what's called a streamlined refinance, which is basically the same thing, but it just has fewer requirements and lower costs related to obtaining the new loan. Again, I'm going to cover this in greater depth in the future, but it's just another version of a rate and term. So how do these refinances work? And more importantly, when should you look to do a refinance? So first off, the requirements are basically the same as they were when you got your loan original. Again, streamlines being somewhat of an exception to that. But more or less, you still have to have your credit pulled. You still have to have a debt to income ratio that fits the loan program. However, in most cases, you will not need to pay much of anything out of pocket to do this if you don't want to. And oh, by the way, you can do any kind of refinance with any mortgage lender you want. You see, there's a common misconception that you have to do this with your current lender, or that you'll even get an easier or better deal if you go with that current lender. When in fact, in many cases, you might get a worse deal when you work with your current servicing bank than if you called and talked to other lenders. You see, the bank that already has your loan in their system knows that you're not likely to shop around because it's easier just to call them. So they'll often take a little bit of advantage of this and maybe give you a slightly higher rate than you could have got if you just shopped around a little bit. All right, so a borrower completes an application, has a conversation with their lender about rates and costs and payments. Then the lender collects the necessary documentation. You might have to order an appraisal. This is always going to depend on several factors like your loan to value, how much you owe versus how much the house is worth. It also depends on what type of loan you're doing. And honestly, if the value that your lender puts in the automated underwriting system is accepted by the algorithm. You see, getting that appraisal waiver can be a bit of an art in some cases. So make sure your lender has had some experience doing these things. Then, as long as everything lines up and your value is good, then you can often roll all of the closing costs into your new loan. Yes, there are still costs. There are never loans that get done without costs, regardless of what the internet and advertising tells you. There are title fees, credit reporting fees, possibly appraisal fees, recording charges, et cetera, et cetera. And if you think that a lender is going to do a free refinance for you because you're just such a great guy or gal, then I've got some oceanfront property in Arizona that I'd like to show you. So there's always costs. It's just a matter of who is paying the cost, you or the lender on your behalf. You see, your loan amount may not increase by the amount of the costs like it does in many streamlines, but that just means your rate is most likely higher than it would have been if you had rolled the costs into your loan instead of electing a quote no cost loan. You're going to pay for it somewhere, whether it be in the actual costs or a slightly higher rate than is otherwise available to you. Now, the real question is, when does it make sense to refinance? Now, here's where figuring out all this might actually be easier than you think, because for a rate and term refinance, it's actually a pretty simple formula to decide if now is the time to refinance or if you should wait. You see, all you have to do is take your old payment and compare it to the new payment with the lower rate. If you save enough on the new payment to break even on the costs associated to doing the new loan in less than 3 years, then it's probably time to pull the trigger. Now, there are a couple extra things to consider here though. If you're moving from a 30-year loan to a 15-year loan, your payment is most likely going to go up, not down, because of that shorter term to pay off the mortgage. And figuring out the math on if that makes sense takes a little bit more data about the interest savings over time and then the cost incurred. Also, if you're doing a streamline for an FHA or VA loan, then there is no cost added back to your loan. They can't. And in that case, it almost always makes sense. You just might want to check and see what the rates look like if you didn't do the streamline and added in the cost of the loan instead. You might actually get a better deal in some cases. And the last thing to consider outside the basic formula is where the overall interest rates are headed. Are they going to continue to decline? And is right now a little bit too early to refinance? So how do you know if you should wait? Well, if you listen and follow this podcast, I help answer that question each and every week. But otherwise, you need a knowledgeable, experienced lender to help you gauge where rates are headed. And if now is the best time to pull the trigger, or if you should wait just a little bit longer. Now, other than those circumstances, if you subtract out the costs of setting up your new escrow account, this is where your taxes and insurance get paid out of. You see, you do this actually because your current escrow account gets refunded back to you after you close and pay off your old loan. It's almost kind of like a little mini cash out. It is your money, and that money is just being put into your new loan, but you don't need to do anything with it because you have a new escrow account that's already set up for you in most cases. So you can just keep that check that you get back from your current servicer and do whatever you want with it. Also, you get to skip at least one mortgage payment. And if you do it right and time it correctly, you can skip two. So you take the total costs, subtract the escrow setup, and divide it by the amount your mortgage payment is coming down. And if that number is less than 36 months or 3 years, then you are golden. So if your total actual loan costs were say around $7,000 and you were saving about $200 a month on your new payment, that number comes out to 35 months to break even on the cost. So if you aren't planning on moving or selling in the next 3 years, then this is an absolute no-brainer. Now, if that number comes out to 3 to 5 years to break even, then it becomes kind of a personal preference at that point. If you know for sure that you aren't planning on moving anytime soon or doing anything different with your home situation, it could still easily make sense. However, if it takes more than 5 years to break even on the cost of this refinance, I would say that it absolutely does not make sense. And the reason is that 5 years is just too long of a time horizon to know where life is going to take you. So in that case, it's often best to wait until the math makes more sense. And that's it. Pretty simple stuff. Now, if you have questions about any of that or want more information on how all the other refinance programs work, give me a shout. I'd be happy to walk you through all the options. And trust me, you can find my contact information pretty much anywhere on the internet. So give me a buzz. Well, folks, that is all for today. I hope you got a lot out of today's episode, but I just want to say we are living in some unprecedented times. And the only way through all this insanity is by sticking together. We all have our differences, but at the end of the day, everybody wants the same thing. We want to have the opportunity to provide for and protect our loved ones. We all want to find a safe place to live and settle down and raise our family. And we all need that human connection that binds it all together. More love, more understanding, more compromise, and more kindness. Because if we all just focus on how to be the best versions of ourselves every day and stop worrying about everybody else, then often the rest takes care of itself. So until next time, be great humans and keep grinding. Life is what you make it. So make it great. See you later.